The trade desk stock is down over 63% year to date in 2025. Of course, one of the main reasons why the trade desk stock is down so much is because of increasing competition from Amazon, which is expanding into the demand side platform business, according to its management team's ability to expand into new markets. And investors are always concerned when Amazon decides to expand into new markets because they've been so good at taking market share in new market categories, dismantling industries and disrupting industries and companies. So it's understandable that investors are concerned about the trade desk's prospects against Amazon in this important category. But I'm going to talk about the company's most recent quarterly earnings results and some of the specific reasons from that quarterly earnings release that's causing the share price to fall in this previous week. And then I'll look at the company's longer term performance on critically important metrics like revenue, profit margin, returns on invested capital. And I'll share with you my valuation of the trade desk using my proprietary DCF framework, all to come to a conclusion to answer the question you might have right now if this is a buying opportunity on the dip.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in its most recently completed quarter, which ended on September 30th, 2025, the trade desk reported 18% revenue growth to $739 million. In the 9 months ended September 30th, the trade desk's revenue growth has slowed down to 20%, rising to $2.049 billion. A couple of things to note here. One, the company's revenue growth is decelerating in the most recent quarter and in the most recent year, from 27% to 18% in the most recent quarter, and from 27% to 20% in the 9 months ended September 30th. So the second derivative is decreasing, and that's a negative sign for stock market investors. However, I will say that when you're looking at these kinds of second derivative statistics, it's important to compare it against the valuation of the business. And we'll talk about valuation a little bit later. But in short, the trade desk is trading at a very cheap valuation. So I'm looking at this from a different perspective compared to if I was viewing this on a business that had a valuation with the forward price to earnings in, above 100 or 200 or 300, which is like a super premium valuation, right? So when you're shopping for something that's not expensive, you look at it differently than if you were shopping for something that's expensive, right? When something is expensive or in the luxury category, you want everything to be just right. You want everything to be perfect. But when you're looking at something with a cheap valuation, you're a little more lenient. You give that product or service or investment more rope because it's a cheap value, it's a cheap price. And that's the perspective I'm looking at the trade desk. It's trading at a relatively cheap price. And again, I'll talk about valuation towards the end of the video. Its adjusted EBITDA margin actually increased in the most recently completed quarter to 43%, up from 41%, and remained at 39% in the 9 months ended, and the same as the period last year. A couple of things to note: customer retention remained over 95% during the third quarter, as it has for the past 11 consecutive years. Customer retention is important because I value the customer value proposition as one of the most important things when I'm evaluating an investment. So I like to see a company maintain a high customer retention. But by the way they're reporting this figure, it raises more question marks for me than makes me feel comfortable as an investor. As a shareholder myself, I own the trade desk stock. I bought it during the crash around September, I want to say October. I bought the stock at around $45 a share. So what I would prefer to see from the trade desk is not just telling me, hey, customer retention has been over 95% for the past 11 years. I'd like to see them display the customer retention number and the trend over these past several years and where it's moved. Is it trending downward? Is it staying flat? Is it increasing? I would like to see that chart here in this statement rather than telling me that the customer retention remained over 95%. over the past 11 consecutive years. The number itself, it's good that you're sharing that number with me, but I would also like to see the trend, the history of this number. Is it improving? Is it worsening? Is it staying flat? That's the question I want answered. So, a key hire for the trade desk, bringing in Anders Mortensen from Google, with 25 years of history at Google, scaling advertising businesses. Not 25 years at Google, but 25-year history in the advertising industry. And I like when companies make, especially when smaller companies make hires from bigger companies. And this is one of those signs here, especially a bigger company in your own industry, Google being a dominant advertising, the leader in the digital advertising industry. So to bring someone of senior rank from Google to your team, I see that as a positive. So in the most recent quarter, the company used $310 million of cash to repurchase its Class A common stock. And as of September 30th, they had 60 million available for repurchase. And in October, they used that 60 million as well. So all of the money they had available to buy back stock, they used up. That's a strong sign that the management team feels the stock is undervalued. Furthermore, the company also announced that its board of directors approved an additional $500 million under its share repurchase program to buy more stock. So again, more signals from the management team that they believe their stock is undervalued. And for Trade Desk, $370 million in stock repurchase is a relatively large sum, considering that the company only generated around 700 million in revenue in the most recently completed quarter, and they had cash on the balance sheet of less than 2 billion. So they used a large percentage of the available cash they had to repurchase stock, and they added another $500 million so that they can go out and buy more stock. So looking ahead, they're forecasting revenue of at least 840 million, with adjusted EBITDA approximately 375 million. So let's compare that with the third quarter. Third quarter's revenue was 739 million. So they're expecting a quarter-over-quarter increase of $100 million in revenue. That's a strong increase. And adjusted EBITDA came in at 317 million in the most recently completed quarter, and they're forecasting 375 million. So an incremental increase in 60 million in adjusted EBITDA. So of the incremental increase of 100 million in revenue, they expect 60 million of that to flow to adjusted profitability, which again is another indicator of the company's strong profit margins and strong unit economics, which I'll share more about towards the next part of the video. Income from operations jumped from 108 million to 161 million in the most recently completed quarter, and from 231 to 332 million in the 9 months ended September 30th. Cash flow from operations in the 9 months ended September 30th increased from 540 million to 681 million. So far, everything we looked at indicates a very strong business. The only thing that was not ideal was the company's decelerating revenue growth, but it was still strong revenue growth, near 20% in the most recently completed quarter, in the most recently completed 9 months. That's about the only thing that you can pick on so far that wasn't very good in this completed quarter. Now, one thing that was not great, it was the increase in capital expenditures for property and equipment, which jumped from 78 million to 171 million. This was a sharp increase, a more than 2x increase in capital expenditure, which spooked investors a little bit. And so whenever I see a company that's undertaking increasing spending plans, I always look at their historical returns on invested capital to see how good the company's management team is at allocating capital. Is this a management team I trust in using money to add new products and services? And if it is, then I actually like it when the company increases their capital expenditures. So now let's look at some of the longer term stats of the business. Revenue growth has been great, from 100 million in 2015 to 2.7 billion. That's good for a compounded annual growth rate over 39%. That's really strong revenue growth over this 10-year period. Furthermore, they've grown revenue at lucrative profit margins and lucrative cash flows, their cash flow from operations to sales ratio has hovered around and above 30% for the better part of the previous 5 years. And that's up from negative levels in 2014, 2015, and around 10% in 2017 to 2019. And in the most recent 5 years, it's been 31, 35, 31, 30, and 35. So well above 30% in the previous 5 years. Strong cash flow from operations to sales ratios. The return on invested capital has been volatile, returning to growth here since 2022, but from 2016 to 2022, it had been declining. But if you look at overall from 2025 to 2016, there was only 1 year where the return on invested capital was below the company's weighted average cost of capital. And as long as a company is delivering ROIC above the weighted average cost of capital, it's adding shareholder wealth. And in the most recent completed 2 years at 27%, that's a ratio of over 2 to 1 for the trade desk in terms of ROIC to WACC. And historically, if you look at the average, it's been well above its weighted average cost of capital, with only a couple of years that were below 25% in its 10-year history. So overall, I would say this management team has demonstrated effectiveness in allocating investor capital. So I'll feel relatively comfortable in the company allocating capital to improve its offerings of products and services. So now let's look at valuation. And by the way, these charts I'm getting from fiscal.ai, my preferred data provider. There's a link in the description if you're interested in these kinds of charts. The trade desk is trading at a forward price to earnings of 21.85. This is the cheapest this stock has been going back a long time. I don't think you've ever been able to buy this stock at a cheaper valuation according to this metric. And of course, the business faces significant competition right now with the increasing products that Amazon is launching in this category. And so investors are concerned about how the trade desk can hold up against Amazon, which is an absolute giant in every category that operates. And so understandably, risks are higher, so the valuation should be lower. But I think the valuation is overcompensating on the downside. Furthermore, when I look at valuation according to my proprietary discounted cash flow model, the stock also looks undervalued. I calculated an intrinsic value at 65. The current market price is 43. So it looks undervalued according to this metric as well. So regardless of which metric I use, the stock looks undervalued. So to put it all together, do I think the trade desk stock is a buy on this dip? I think so. Yes, it's trading near its 52-week low. And while the risks are elevated, the upside is huge. And I like this business the way they've been able to demonstrate capability and effectiveness in growing market share in a very attractive industry, the advertising industry, and the most attractive part of the advertising industry, which is the digital advertising industry. They're buying back shares, signaling the management team thinks the shares are undervalued, and the allocation of share repurchases puts a bit of a floor underneath the share price, because if it keeps falling, the management team will likely jump in and purchase more and more shares. They've got $500 million to spend, and the company's market cap is just over $20 billion. So it's a meaningful chunk of the market capitalization, the share buyback authorization. For me, I own Trade Desk stock myself, and I'm interested in adding more shares. I will reiterate my buy rating for this business today. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.